Good morning, everyone. Welcome to the Macro Snapshot. We are Tuesday, August the 12th, 2025, recording this in the morning before the CPI. I just want to briefly mention yesterday we did get some data. We got some news out of sort of Trump that basically he's given an extension of 90 days for trade talks, about the tariffs to continue with China. So for me, it's interesting that he's taking a gentle approach with China compared to, let's say, countries like, especially Europe has been quite tough with Switzerland, Brazil. Canada, there's some other trading partners. So definitely with China, he's trying to treat that in a diplomatic way. The market didn't have too much of a reaction. I mean, there's a general positivity in the markets, but I think the market at this point is expecting that to be sort of a long, complex, and drawn out negotiation. Let's see what happens. The other news overnight was that the Reserve Bank of Australia, they did cut 25 basis points as expected. You see here the chart AUD versus the Aussie versus the US dollar, and you can see here that it's a bit soft on overnight sort of price action, and just here it's kind of fading a little bit, just sort of a sideways consolidation, just running out of a bit of energy. All the moving averages here just now down below the 20 and the 50 EMA, heading down towards maybe a bit of support here at the 100 and the 200, probably just trading in a range. And really it's going to be dependent probably on what happens with China, global trade. But we did get some comments out of the monetary policy from Governor Michelle Bullock, and she essentially what the bank said in Australia was a quote here that inflation has moderated. They do believe that inflation will moderate down to their target, which is between 2 and 3%. So keep in mind in Australia that they don't have a hard 2% target. It's a bit more flexible. It's like New Zealand. It's between 2 and 3%. So if it's somewhere in the mid twos, they're reasonably sort of content with that. The second thing is that in the statement, they said that outlook remains uncertain. And they did highlight that they think there are some risks to the downside, especially if sort of, global tariffs and trade sort of complicate things. And they also saw a little bit of softening in employment. So a relatively downbeat assessment. And also in the sort of the medium-term projections for GDP growth, they revised those down from 2.25, so 2.25% down to 2%. So not a huge downward revision, but overall the tone of the statement was, I would say, cautious, and therefore that justified the rate cut. And also in the statement they said that they weren't necessarily going to cut at every second meeting. They could do back-to-back cuts if the conditions warranted that. So a relatively, as I say, sort of cautious. I'm not going to say dovish, but sort of a cautious dovish kind of statement. And therefore the Australian dollar not showing any strength in that. In fact, sort of coming down a little bit and showing a little bit of softness. Okay, just overall, let's just see what we've got here. We've got a VIX, which is down, it's up about 16.5. So it's up a little bit here, but still quite low levels. But, it's off, its lowest levels of, let's say the last sort of month or so. So up just a smidgen here. And if we look at the stocks here, we can see that the stocks, still holding in there at highs, but basically the ES, failing to retest the high here. We can see NASDAQ also failing to retest the high, but still, sort of quite robust. If we look at the Mag 7, we can see the Mag 7s actually had a little bit of a reversal candle yesterday. So that's going to be interesting to see what happens there. And the equal weight, as always, a little bit weak, as is the smaller cap Russell here. So definitely a little bit of divergence. We have the equal weight and the Russell, the small caps, under a little, I don't want to say pressure, but less strong than the market leaders. But as we see here with the Mag 7, just a little bit of a reversal candle here. And it's going to be interesting to see what happens with the CPI today, and if there's going to be any follow through, because that could indicate some kind of short-term top and sort of a topping formation. We'll see what happens there, but definitely the market looks as though it's very overbought. But having said that, we've been saying that for 2 or 3 months, and if you look at the moving averages here, let's say on the Mag 7s, you can see that that's very, very strong, well above the 20-day and above everything else. I mean, maybe just a little bit of concern yesterday, because it is highly unusual. We almost have this sort of interventionist stance now that the US government is happily sort of demanding and accepting 15% of the sales of Nvidia and was it AMD to China, which is fairly extraordinary. They were accusing the Biden administration of too much state intervention in the economy, and here we are, sort of almost like a pay to export kind of scheme being run from the White House, which is a little bit shocking, all things considered. So maybe that's given the tech industry or the tech, sort of sector as a whole, a reason to pause and have a little bit of a think about the future. Okay, apart from that, of course, the big one today, just finally, I just wanted to mention that in Europe, we did have the ZEW sort of economic sort of sentiment survey, which is quite an important survey. And that was actually pretty horrible. That was last time. Keep in mind that last time that came in at 52. This is just the Bund up. Bund didn't have much reaction. But the ZEW survey in Germany, as I say, it's a big survey of sort of economic confidence and current conditions. That last time was 52. Expected this time at 39. So pretty bad, but actually came in at 34.7. So it came in very, very weak. So all that's to say that definitely over in Europe, or at least in Germany, in the sort of, sort of a private sector, there's quite a lot of pessimism, I suppose, about the tariffs and the eventual effect, through effect that's going to have on the German and the wider European economy. So interesting there, fairly negative sentiment. But also interesting is that the German bonds here, the Bunds, didn't react in a positive way on that downbeat news. I mean, keep in mind it is a survey. It's the middle of August, August the 12th. Probably 90% of trading desks are semi-closed or just being stuffed by interns. So let's not overread into that. But not a huge reaction. And if we look at the reaction of the, let's say, the German index, the DAX, you can see that was definitely down, as the Stoxx 600. So, a little bit of sogginess over in Europe in terms of the equities, not loving that survey data. But again, as I say, we're almost, in the middle of August here. So, it's difficult to over read too much into things. What we do have in the US today, of course, is the CPI. And this has got to be important because we know that in terms of the twin mandates, the Fed, there was the sort of the fairly shocking revisions to the employment numbers. We know that Trump fired the head of the Bureau of Labor Statistics. He now has a new person in, or he's nominated a new person to get sort of true and accurate data suddenly. So that's interesting. But really, in terms of the Fed, we know that we've had two or three doves come out and say that because the jobs number is sort of, it seems to be weakening the labor, it's time to start cutting. And a lot of these people, a lot of the more dovish members of the Fed are saying that the CPI is, it's reasonable, it's between 2% and 3%, and that any tariffs will be, sort of a one-off kind of almost like a tax or just a one-off price hike, and it's not necessarily going to be indicative of underlying inflation. So I'll have some tea. Today, we start to get a little bit more information about the CPI, assuming the data is correct and not manipulated. I mean, as always, if we just look here, so this is for the July period. So, not the most up to date, but nonetheless, this is certainly, starting to incorporate, a little bit of the effects, one would suppose, of tariffs. Although a lot of the stuff I've been reading, a lot of the research I've been reading really leads to the fact that the full pass-through of tariffs onto the consumer, onto importers, onto producers, wholesalers, retailers. It's a very complex chain, and a lot of people are saying that this might take 3, 6, 9, 12 months to fully filter through into the system, and also onto the behavior of consumers and the ability of companies to, even if they want to raise rates, raise prices, to be able to raise prices. Two different things. If you want to do something, maybe you can't actually do it because there's too much consumer resistance. Anyway, so let's see what's expected today. As you can see, the overall number, so the CPI year over year, expected to actually pop up a tenth from 2.7 up to 2.8. And if we look at the core number year over year, I mean, look at that up into the threes. Now, if you annualize that, we're talking, plus 3%, obviously, sort of three. Well, actually, that is already annualized. I was more talking about the monthly numbers. If you look at the monthly numbers, the core monthly number, that's expected to attenuate down to 0.2, but the core, which is probably the most important one for the Fed, expected to go up from 0.2 to 0.3. And my point is that if you annualize that core number, you're getting, well above threes, maybe, 3.4, 3.5, 3.6, which in theory is well above the Fed's mandate, and certainly not really a justification for cutting. But hey, I think politics is there. Let's just see the estimate here. I've just got the estimate here for the ex-food and energy, so the core number month over month, which, as I say, is the most important one. Relatively even distribution. We're seeing here that the median is for 0.3. Technically, I mean, the unrounded is going to be interesting is 0.29. So really try and, when we get the data, let's see if it's, because, it could be 0.26 or 0.34. So between 0.26 and 0.34, that would actually come out as 3, but there's quite a big difference between 3.4, 0.34 and 0.26. So always interesting to get the unrounded number. Again, the standard deviation is 0.6 here, so keep that in mind, that anything above one standard deviation on either side should get a bit of a market reaction here. And you can see that here, it's indicated, I wonder if that actually tells us here, 0.2, and then up there, we're just saying 0.3. So it's not giving us a huge amount of information, but definitely, but from what I'm reading as well, a lot of the market, in my humble opinion, is sort of expecting, I would say, a slightly hawkish number, slightly, so I think even a downside, it could have a bit more of a sort of a market reaction. If we get up to 0.29, 0.3, I think the market will deal with that. But it's really a sort of a weak number. I think it's going to have a much bigger reaction. And the whole point here is that will it confirm that sort of recent dovish pricing we've had in terms of the Fed expectations? If we actually look at that, we can see what's priced in at the moment. We can see that for September, actually about 21 basis points. So it's an 83% chance of a cut in September. And this is going to be important, this number today, because if this number comes in hot, presumably the September pricing will go down at least, maybe 5 or 7 basis points. On the other hand, if the number comes in soft, let's say 0.2 or well below expectations, of course, that this September cut could be sort of fully priced in. So we could see, 4 or 5 basis points of more dovishness priced in, which of course is going to be good for the long end. The front end be bad for the US dollar, so weakness in the US dollar. Bonds in general should like it, but it ultimately should be a front end led bull steepener. So the front end will like that a lot more than the back end. Gold will like that. Equities, I think, would like that because the way equities have been trading recently is the fact that they quite like a more accommodative Fed, and a little bit of inflation is not necessarily horrible because companies with pricing power will be able to raise the nominal prices, and so their nominal income will be potentially raised, adjusted upwards. So it's not necessarily a disaster, especially for strong companies. I mean, especially if that's allied with Fed cuts. So that's interesting. What is also interesting is just to see some of the sectors which are most exposed to tariffs, because really what we want to see is what's going to happen with tariffs. And I've just got here something from Goldman Sachs. Basically, these are some of the categories which are the most exposed in theory to, exports or imports coming into the US, which are the most exposed to tariffs. So this is really, the most exposed ones. So you've got things like photographic equipment, glassware, tableware, luggage, communication equipment, video and audio equipment, clothing, footwear, household appliances, a lot of this stuff. So a lot of these baskets, that's the kind of thing afterwards, which I think the market will be looking at and just really trying to understand not just the overall numbers, like the headline number and the core number, but really trying to dig down a little bit more and see whether there is an effect from tariffs. So if you see any sort of, news and information afterwards, just analyzing some of these, household appliances, clothing, footwear, as I say, video, audio equipment, all this kind of stuff, communication equipment, just to have a look and see if they are going up particularly, because I think even if the market sniffs out or senses that the tariffs are really starting to hit some of these sectors, I think it will extrapolate from that tariffs, the tariff effect could be real and it could be inflationary, and therefore there'll be market reactions from that. So really, let's keep an eye out for some of the more granular stuff there. I mean, other sectors to be looking out for is sort of airline prices, apparently looking for a 2% increase on airline prices, cost of new cars, car insurance. These are some of the key areas as well. And of course, sort of shelter as always. In terms of market movements, just interesting to look at the volatility here. We've just got, again, I think this is from, JP Morgan or Goldman Sachs, I pulled this, but this is basically the VIX, well, this is actually from about 48 hours ago. So the VIX is now actually about 16 and a half. So if we actually look at the move, the moves in the last few CPIs, they haven't been that big. So the implied moves have been, between 50, 60, 70 basis points. And the actual realized move has been a lot less. So pretty low sort of volatility expected. If we actually just look here at the ES futures, which I've just pulled up in real time, we can see that overall the volatility is quite low. So you see here ES down here, September contract. You can see that the implied volatility percentiles are only 5%, so very, very low in terms of percentiles for the 52 weeks look back period. And if you look at the ranking, slightly different metric, you'd see that's only 32 out of 100. So all things to say that the implied vol is pretty low at this point. If we look at something like a straddle, this is the zero DTE here. So let's just put on a straddle, and we'll go at the money, of course. So you see the delta here, 47. So let's do. So what you can see here is that the straddle here is, just make sure I've got that right, delta 47, delta 52. Yeah, so you've got a straddle with a strike at, let's say, 6,400 on the ES. You can see that the price for that is about 43. So that's 43 points, which equates to about, what's that, about 170 ticks. So it's still pretty low. And if we actually just look at it in terms of percentage move, I just want to have a quick look here. So if we just get the percentage here, 43 divided by 64. So the implied percentage move here is 67. So 67 basis points, so 0.67. So that's all we're expected, which is fairly low, as you can see, sort of historically. So, the market not expecting, not priced for any sort of dramatic move, and I think really to go more than that kind of move. So again, this was saying 70. So literally in real time, it's about 67 sort of basis points of a move. So we'll see what the actual move is by the end of the day. And as I say, the VIX up just a little bit more at about 16 and a half. In terms of market reaction, just got a couple of things here. This is from the Goldman Sachs trading desk. So in terms of the SPX, so the overall sort of stock indices, if it's a sort of a low print, they'd expect the SPX to bounce, 70 basis points, more or less in line, a small sort of positive reaction. In terms of sort of a negative reaction, really, if you get anywhere above 35 to 40 in terms of the unrounded number, looking for a drop of 50 basis points, and obviously a very hot number, anything greater than 4% is, 0.4%, 40 basis points is not expecting. And Goldman's trading desk saying that they would expect then a pretty nasty sell-off of 1.25%. A similar kind of thing here, this time from JP Morgan, just to see what they are saying. If it prints above 0.4, they're saying 2 to 2.75, so a lot more of a sell-off. So interesting that JP Morgan would say anything above 0.4% would be a 2 to 2.75% sell-off, whereas Goldman's is a little bit more sanguine, saying only about half of that 1.25. So that's interesting divergence there. In terms of a low number, let's say below 0.25, so a soft kind of cold number, that JP Morgan be looking for SPX to gain 1.5 to 2%. But again, that's low probability, 5%. Their base case probability, which is assigning 70% probability for 35% probability, is between, about 3 and 3.5, or maybe 2.5 and 3. So somewhere in there is more or less what the market is expecting. Okay, guys, I think that's it for today. I'll leave it there. I want to get prepared for that. Again, if it's a cold number, obviously that would be good for gold, bad for the US dollar, good for the euro. That would cause a front-end led bull steepening. So the yields on the front end would come down a lot more dramatically. That's going to be great for the TUA or for the ZT, something like that. The stocks, I think, would like that. Anything hot, as we just saw, anything very hot, I think the stocks would not like that. That'd be strong for the US dollar, a positive for the US dollar, bad for gold. And of course, the front end of the curve would not like that at all. So it would get a front-end led bear flattener in that point. In terms of the equities, I think the equities are looking for something just in the mid-range. Anything I don't think equities want anything too cold, like 0.1 or something, or 0. I mean, something crazy like that, because that could indicate almost like a deflationary sort of situation and a slowdown in demand. And on the other hand, they of course don't want anything like 0.4, because it could cause the Fed to really sort of pause. What the equities are looking for, as we saw from some of those trading desks, are really just something, in the twos, 2.0, 0.27, 0.28, which basically will not derail the Fed and will allow the Fed to keep on cutting, but was not going to be too hot in order to create problems in the real economy with consumers. Okay, we'll keep this going tomorrow, guys. Have a great day, and thank you very much.